Good evening, good afternoon, good morning, wherever you're watching or listening to us from today, the 16th of January 2025. You're welcome to Stalker Team, the Investors Channel. We are happy to have you here to actually also talk about one of our picks for today. We'll be talking about the top ETFs that we are actually recommending on this channel. What you know us for is to always come with stock picks and also some of these stocks that can actually, make you perform better as an investor, make your portfolio actually do a better return by the time we get to the end of this year. So basically today, we will be looking at the top ETFs. But before I do that, a little bit of housekeeping. Every information shared on this channel is for education and information purpose only. So please do your due diligence, consult your financial advisor before making any decision. And on that note, we thank everyone who has been with us. If you're watching us for the first time, you haven't subscribed to this channel, please subscribe, put on the notification bell so that you don't miss any updates, because we promise to keep bringing you all the best ideas that will actually, jive up your portfolio for the year to make you a better investor and get you better returns. On that note, let's quickly look at the market roundup before we go to the topic of today. So today, Apple is actually looking to replace Goldman Sachs with Barclays as the credit card partner. Apple has the Apple Card, which has been on suspension for a while. They are ending the relationship with Apple with Goldman Sachs, and Barclays might actually be the winner in this case. They are talking to some other providers as well. Apple is actually down by almost 3.2%, but the losses have actually reduced earlier today. Nothing major, not any particular negative news. BP is looking to cut about 3,000 jobs to actually save cost. BP is not necessarily a buy for us, it's not a sell, it's also a hold. We can talk about that in the future, but they really want to save cost, which might actually be a good news for BP investors or shareholders. Bank of America beats estimate today. All the banks have actually been coming with better than expected results, because we are in the week where the banks actually released all their results. Morgan Stanley also topped estimates. So yesterday we talked about Goldman Sachs, we talked about every other banks that have actually released their results, and all of the banks are doing very well. Goldman Sachs is actually one of the top picks for this year on the Stalker Team list that we actually recommended on the channel. Robinhood's rival in the UK, Free Trade, is actually agreed that they will be acquired by IG. IG is actually acquiring them for about 160 million pounds or dollars thereabout. Robinhood is amongst the Stalker Team Magnificent Seven stock on our portfolio. One of the stocks that we recommend that will perform and outperform. Robinhood did well over 80% on the portfolio last year, and this year is already up by close to about 30% just in this January alone. Tesla is looking to give out more discounts because they are not selling as expected. They are actually reducing almost about $1,600 because they need to move these trucks. It actually shows you why we are also not bullish on Tesla. Yes, Tesla could still do another 30% this year, but it's a hold it's not a sell, it's not a buy for us. Goldman Sachs, they actually said they are being neutral as well. That's really similar to what we think. Now, coming to the topic of today. So as an investor, you don't necessarily just buy stocks alone, because you want to not just get better returns, you also want to hedge against risks. You want to actually basically make sure that you are not just exposed to one sector alone. You are not just exposed to one stock alone, but sometimes you also want to benefit from the actual broad market strength. So if you are investing and you want to actually make sure that you are not just exposed to a particular stock or a sector, maybe e.g. for instance, for us as Stock Active, we are more exposed to the tech sector. So what we actually also do is to have what we have ETFs, or what we call the exchange traded funds. The advantage of the ETFs is to make sure that your portfolio is not just too volatile. Your portfolio is a bit more balanced, and you can also benefit from the entire broad market strength. So today we'll be looking at the top 5 ETFs that we are recommending that are going to either perform or outperform. We don't necessarily have a price target. We don't necessarily have an entry price, because ETFs are not necessarily stocks. ETFs oftentimes, they are a group of stocks that actually track a particular sector or a particular group of stocks. So for instance, there's the ETF for the airline industry, or ETFs for airline industry. There's the ETF for consumables. There's the ETF for the financial services sector. There's the ETF for the insurance sector. There's the ETF for even information technology, the technology sector, a whole lot of every major company or sectors that is represented in the US and the global stock or financial market as its own ETF. So depending on your interest, depending on what you are trying to achieve, you need these ETFs, because number one, ETFs are not as volatile as stocks. Number two, ETFs allows you not to just be over concentrated in a particular stock or group of stocks, but it allows you to gain the benefit from the price appreciation of some of the best stocks in a particular sector, or a particular group of stocks, or a particular ecosystem that you might not necessarily be able to pick the particular stock that you think you want to actually buy. So on that note, we'll be doing as usual, like yesterday, we'll be doing the demo to actually show you what these ETFs have actually delivered in the last 5 years, in the last 3 years, in the last 1 year, and what we think and why we are choosing these ETFs. So basically, if you have watched, if you have watched to this point, please subscribe to our channel, put on your notification bell so that you don't miss any updates. Now let's go to our demo for the day to actually talk about the first ETF. So the first ETF that we'll be looking at today is the VOO, which is the Vanguard S&P 500. The ticker symbol is VOO, which is Victor Oscar Oscar. That is the USD version of this ETF. And this ETF also has different versions. So depending on which major economy that you are based in, maybe you are based in the US, you're based in the UK, you are based in Canada, you're based in Western Europe, the major one that is actually the most recognized version of this ETF is the Vanguard S&P 500 VOO, which is VOO. Now, you all know we've explained what the Nasdaq, the Vanguard S&P 500 is. Basically, the S&P 500 is the top 500 most capitalized stocks on the US stock market, quoted on the US stock market, and they are mostly American companies. Now, these companies don't just deliver dividends to their investors. They deliver more revenue, they book more revenue, they are more globally, or their operation is more entrenched in the global economy. They have huge customer base or innovation, intellectual property. As a result of that, many of them they've also been tried and tested in the market, and they are not new companies into the stock market. So this Vanguard S&P 500 ETF actually tracks these companies. And last year alone, going to our demo, Last year alone, the Vanguard S&P 500, which is the VU, did about 24%. Now, the advantage of this ETF is that instead of you not being able, if you're not able to actually pick, you don't want to buy Apple because you're not too sure, you don't want to buy Microsoft, or you don't necessarily have so much money to invest, and you want to actually build your portfolio over time, and you don't also have that time to do all the research like we do here, you can actually look at this ETF, because last year alone, 24%. That is way more higher than what you actually get for any savings account, no matter how high interest savings account they call it. In the last 5 years, this ETF has returned 78%. So it is oftentimes seen as a low risk, an easier way to actually invest in the stock market. And if we look back, since this ETF was actually listed, it has delivered a whooping 435%, all-time high. This is very remarkable, and this actually takes me to the next ETF. So if you are in the UK, before I go to the next ETF, let me just clear something. If you are in the UK, the version of the UK, if you invest and you are based in the UK, the version which is quite popular, which is the same thing, just like the VU, is the VUSD, and that is listed on the London Stock Exchange. Is exactly like the VU, and the composition, the weighting, the entire exposure, and everything is just mirroring what VU does. So if you're in the UK, this is actually the one you will search for on your broker, depending on what your broker. So if you look at the last 1 year as well, it's exactly the same 24%. If you look at the same, the all-time high, almost exactly the same because of currency basis, 349%. The other one was, 350 something percent. So going to the next ETF, let's go. The NASDAQ 100. The NASDAQ 100 ETF is actually one of the best ETFs to have. Now, if you are looking to invest in the tech sector, the tech sector is actually very, very volatile for so many reasons. Number one, these tech stocks tend to have higher valuation. Most of them are growth companies. They tend to move very fast. And if the market is having a whole lot of microeconomic news that is not too positive for the US economy or the global economy, maybe like rising oil prices, rising interest rates, rising inflation, and some other geopolitical news headlines that are not too positive, the tech sector, because they usually run very high, because investors, shareholders believe that they will return higher return, higher revenue, higher profit forecast, and all that, or net income. Most times when there is that negative undertow, you see these tech companies, tech stocks, moving very fast to the bottom. And some of them get to lose about 15%, 10%, 30%, depending on how negative the sentiment is for some number of days or weeks or even months. If you look at what happened at the beginning of this year, you see a lot of sell-offs in the technology sector. The likes of Palantir actually pulled back by about 15%. A whole lot of other stocks about 10%, 9%, 6%. Now, the advantage of the NASDAQ 100 is that you have exposure to the top 100 technology companies quoted on the Nasdaq Stock Exchange. Recently, Palantir was admitted to this because it's a bit balanced, and the weighting is also very, very well calculated. The rate at which this pulls back is actually a bit more less volatile. So for me, this is one of the best picks if you want to be exposed to the technology sector and you don't actually have that stock picking strength, stock picking knowledge, you don't have the time to do the research. You might actually look at this on any of the brokers that you use. Just search for the NASDAQ 100 ETF or index fund. You will actually get this. The next one I want to talk about is actually Jet ETF. So the Jet ETF is quite interesting because this ETF has really suffered in the last few years down the line. But if you look at the last 1 year, this ETF has been one of the best performers because the airline industry has really gone through a whole lot of headache, a whole lot of trauma, a whole lot of stress in the last 20 or the last 15 years. So if you look at the 9/11 terrorist attack on the US, if you look at the 2007 2008 global recession, which led to a whole lot of companies folding up, bankruptcies and all that, firing and layoffs and all that. If you look at the COVID pandemic, if you look at the shutdown, lockdown that happened, if you look at the crisis in Ukraine and all that, all of this actually affected the airline industry very massively. But in the last 1.5 year or 2 years down the line, the airline industry seems to be looking up in a more positive tone. Even when we see, global oil prices creeping up, going up almost to the all-time high prices and all that, airlines are now actually more funded. Many of them are now more managed. They've been able to actually manage themselves to actually, adjust to the new normal. And this ETF, if you type JETS or Jet ETF on any of the brokers that you use, you'll be able to actually see this ETF. It is one of the top picks for this year as ETFs that we recommend because a whole lot of the airlines, if you see all their recent results and also their result for the entire of last year, they've been very positive because the management of some of these airlines are now actually more experienced to actually manage airlines on a global scale, irrespective of the microeconomic or geopolitical challenges that might actually happen. So this ETF will actually do better this year because if you look at the way the global airline is already moving this year alone, this ETF has already done over 2%. Let's see what we are going to see in the middle of the year. We'll be doing a review. If you are still watching us, please subscribe to this channel, put on your notification bell if you haven't. We really love you, and we'll continue. The third ETF that we want to recommend is the VanEck Semiconductor ETF. Now, if you look at what has happened in the last 1 year and 1.5 years, the semiconductor or chips ETF, which is directly linked to the artificial intelligence ecosystem, has really outperformed a whole lot of other ETFs. So if you trend back in the last 1 year, a whopping 45%, just having these ETFs, and perhaps, you just, dollar cost average, you just buy from time to time. Last year, you will have gained 45% aggregate in the last 1 year. If you look at the last 5 years, this ETF has returned over 249%, which is way higher than what a whole lot of other ETFs have returned. If you look at the last time, all-time high, this ETF has done over 513%. Now, what are the companies that are actually in this ETF? The likes of Nvidia, Taiwan Semiconductor, ASML, the likes of Broadcom, Micron, Lam Research, Texas Instruments. All of these companies in the semiconductor chips manufacturing ecosystem that are quoted on the stock market are actually the best of the best. And you could see that last year alone, Nvidia did well over 151 to 140%. Taiwan Semiconductor almost about 200%. ASML did so much. The artificial intelligence sector is still expected to still perform or outperform this year, and that's why this ETF is actually on the top radar of the ETFs to perform. The last ETF I'll be looking at is actually a very interesting one, because when you look at the manufacturing sector, you discover that it's a sector that a whole lot of people actually do not necessarily understand, or a lot of these companies are actually old. Many of them are not also growth companies. And at the end of the day, when you don't have access to some of this ecosystem, you actually want to actually think that, oh, nothing is happening there. And that's why that ETF that actually track the manufacturing sector is an ETF that you should be looking forward to. We are going to be unveiling this ETF right now. But before I do that, please continue to subscribe to our channel, put on your notification bell, and we will be sharing much more insight for you. So, the ETF that we are recommending this year is the iShares US Manufacturing ETF, or any other ETF that actually tracks the manufacturing sector. So, if you look at what is happening in the US now, a whole lot of the sentiment is now moving towards America actually, rejigging its manufacturing industry. A whole lot of the manufacturing hub in America are likely to actually get more interest, because America wants to actually, create more jobs, enable a whole lot of Americans who are in the blue collar economy to actually not just keep their jobs, but get new manufacturing jobs. And that's why this ETF this year alone, at the beginning of this year, is already done 2.3%. It didn't perform so well last year because the sentiment really wasn't directly focusing much more on American manufacturing. But in the next coming week or weeks, this ETF will actually get a bump, because a whole lot of manufacturers might actually, announce more deals, more factories that they will actually want to build in the US. And the market always front loads. So at the end of the day, most of these ETFs, especially this one, will actually perform this year. And on that note, we thank you so much for joining us. Please, we will be back tomorrow. We have a very interesting topic to share. We've actually talked about the ETFs that we're looking at: the S&P 500, the Nasdaq 100, the semiconductor ETF, the jet ETF, and also the manufacturing ETF. Let's know in the comment section below, which of these ETFs do you actually want to own? Which one do you not see yourself adding to your portfolio? On that note, please keep investing, keep growing. See you tomorrow.